The global financial crisis of 2008 was one of the most significant economic disruptions in modern history. It developed over several years as a result of structural weaknesses within the financial system, excessive risk-taking, and the expansion of complex financial instruments. Following the early 2000s recession, the Federal Reserve maintained low interest rates to support economic growth. This created an environment of cheap credit, making borrowing more accessible to households and institutions. As a result, demand for housing increased, leading to a steady rise in property prices. Financial institutions expanded mortgage lending to meet this demand. Over time, lending standards weakened, and banks began issuing loans to borrowers with low income, unstable employment, or limited credit history. These high-risk loans became known as subprime mortgages. A key factor in the development of the crisis was securitization. Mortgage loans were bundled together and transformed into financial products known as mortgage-backed securities. These securities were then sold to investors worldwide, including banks, pension funds, and investment firms. Although securitization was intended to distribute risk, it often obscured the true level of exposure. Credit rating agencies frequently assigned high ratings to these securities, suggesting that they were relatively safe. In reality, many of these products contained a large proportion of subprime loans, making them highly vulnerable to default. The complexity of these instruments made it difficult for investors to accurately assess their risk. At the same time, financial institutions increased their use of leverage, borrowing large amounts of capital to enhance returns. This significantly increased systemic vulnerability, as even small declines in asset values could result in major losses. The crisis intensified when housing prices in the United States began to decline. As property values fell, borrowers were no longer able to refinance or sell their homes. Mortgage defaults increased, leading to a sharp decline in the value of mortgage-backed securities. This created widespread uncertainty within the financial system. Institutions holding these assets faced large losses, and the lack of transparency made it difficult to determine their actual value. As trust between financial institutions declined, interbank lending slowed, and liquidity in the system decreased. A critical moment occurred in September 2008 with the bankruptcy of Lehman Brothers, a major global investment bank. Its failure triggered panic across financial markets and demonstrated the fragility of the financial system. The consequences were severe. Financial markets declined sharply, credit markets froze, and economic activity contracted globally. Businesses lost access to financing, and millions of individuals lost their homes, jobs, and savings. Governments and central banks intervened to stabilize the system through capital support for banks, guarantees, and monetary policy measures aimed at restoring liquidity and confidence. These actions prevented a complete collapse, but the economic damage was significant. The 2008 financial crisis revealed critical weaknesses in the global financial system, including excessive reliance on debt, inadequate risk management, insufficient regulation, and a lack of transparency in financial products. In conclusion, the crisis was not the result of a single event, but the outcome of interconnected decisions made by borrowers, lenders, investors, and regulators. It remains an important example of how financial instability can develop and spread across the global economy.